Hi, everybody. Welcome back to Ox Talks. It is Monday, February the 5th, 2024. I hope all of you are getting a good start to your week and having a productive day, whatever you're doing. There's a lot going on. We'll share today with the economy, with the banking sector, with mortgage interest rates. We'll address all those things shortly. I apologize for not getting a video up yesterday. I just had a busy weekend working on files for clients, had a bunch of family things to take care of yesterday, and the day just kind of got away from me. I had intended to put something up in the afternoon. I just could not get it done. For anybody wondering, the storm here in Southern California, basically for our area so far has been a nothing burger. I understand that up in Los Angeles they're getting quite a bit of rainfall, and up even in counties north of that. But again, so far here all we have is a lot of cloud cover, a few raindrops earlier, nothing at all to speak of. Happens a lot here. The mountain ranges kind of keep us isolated and insulated from some of the more more severe weather patterns. That being said, thanks for being here today, watching the video. I appreciate all of you subscribing to my channel so we can continue to grow this very astute, very intelligent community that I'm seeing continue to be built, and I really appreciate it. If you haven't subscribed, please consider subscribing if you like the content. Again, as always, please hit the thumbs up button and the bell notification, and share the videos with family, friends, and colleagues. This thing is unfolding rapidly. I say this thing, this economy, and the continued downturn, the constricting lending standards we're going to talk about here in a few minutes. So please try to continue to wake people up that will lend an ear to what you're trying to say. A few articles today. The first one I saw came out yesterday. I wanted to break it down for you last night, just didn't get to it, from the Motley Fool. And it says U.S. money supply hasn't done this in more than 90 years. And it says, although there are a number of prominent measures of money supply, most economists and investors tend to focus on M1 and M2. It says the former is a measure of cash and coins in circulation, as well as demand deposits in a checking account. It's money that can easily be accessed and spent by consumers. It says, meanwhile, M2 money supply accounts for everything in M1 and adds in savings accounts, money market funds, and certificates of deposit, CDs, below $100,000. It's the M2 that's currently in focus that we're going to discuss here. It says most economists and investors rarely pay attention much to M2, given that money supply rises so consistently over long periods. Growing economies require more capital in circulation to facilitate transactions, it says, which results in M2 increasing virtually every year. But it's those rare instances where M2 does decline and consumers are forced to forego some of their purchases that have resulted in trouble for the U.S. and for the stock market. And the article goes on to say, based on monthly data from the Board of Governors of the Federal Reserve System, U.S. M2 money supply peaked at roughly $21.7 trillion in July of 2022. As of December of 2023, the M2 sat at approximately $20.87 trillion. So M2 has fallen by 1.68% on a year-over-year basis and 3.86% since its summer 2022 peak. This represents the first meaningful decline in M2 since the Great Depression, not the Great Recession or Great Financial Crisis, the Great Depression. It says, putting aside minor year-over-year declines, there have only been 5 instances when tested back to 1870, the year 1870, based on data from Reventure Consulting CEO Nick Gurley. It says where M2 has fallen by at least 2%. And that was in 1878, 1893, 1921, 1931 to 33, and July 22 to the current date. All four previous instances led to deflationary depressions and a sizable increase in the U.S. unemployment rate. So we have falling M2 money supply, and that says a lot. It's meaningful when you also take it into connection with the next portion of the article, which has to do with bank credit and lending. It says what's particularly worrisome for the U.S. economy in 2024 is that M2 isn't the only money-based metric offering an ominous warning. Commercial bank credit is another data point worth eyeing that's recently made history. Commercial bank credit includes all loans, leases, and securities, i.e. mortgage-backed securities, held by the United States commercial banks. Similarly to M2, commercial bank credit has grown almost without fail since it was first began to be reported in 1973. It says, but when commercial bank credit meaningfully drops, it says caveat emptor, which means buyer beware or beware. It says spanning more than half a century, there have only been 3 instances when commercial bank credit retraced more than 2% from its all-time high. Number 1, a maximum decline of 2.9% during the dot-com bubble in October of 2001. The second was a peak of 6.94% nosedive shortly after the Great Recession, March of 2010. And then lastly, a drop of 2.07% as of November of 2023. It says, nevertheless, what these drops have signaled for more than 50 years is that banks are purposefully tightening their lending standards. If businesses have reduced access to capital, it means less in the way of hiring, acquisitions, and innovation. That's bad news for both the U.S. economy and, it says, for the stock market. It says, not surprisingly, the 2 previous instances of a greater than 2% drop in commercial bank credit have correlated with a practical halving of the S&P 500, meaning a 50% retracement or drop. So this has impact on consumers. It has impact on the stock market. And this dovetails very nicely into an article that just came out today, actually, from the Zero Hedge, and it talks about the banks tightening. It says, banks report tighter standards, weaker loan demand. And this is from Zero Hedge today, just about 3 or 4 hours ago. It says the latest closely watched SLOOS, S-L-O-O-S report for Q1 was published, and which found that once again banks reported tighter standards and weaker demand for commercial and industrial C&I loans to firms of all sizes over the fourth quarter. Furthermore, it says banks reported higher standards and weaker demand for all commercial real estate CRE loan categories. For loans to households, banks reported that lending standards tightened across all categories of residential real estate other than government residential mortgages and government-sponsored eligible residential mortgages, for which standards remain basically unchanged. Meanwhile, demand weakened for all real estate loan categories, or residential real estate loan categories. It says, in addition, banks reported higher standards and weaker demand for home equity lines of credit, HELOCs, and for credit card, auto, and other consumer loans, standards reportedly tightened and demand weakened on balance. So we have a tightening across the entire spectrum for relative to banks lending money. It says that over 2024, banks on balance reported expecting higher lending standards to remain basically unchanged for C&I and real estate loans, but to tighten further for commercial real estate, credit card, and auto loans. In addition, banks reported expecting loan demand to strengthen across all categories and loan quality to deteriorate across most loan types. Loan quality to deteriorate. That means the quality of the borrowers is deteriorating. And so banks, in order, if they're going to want to lend money out there, they're going to have to start looking at weaker balance sheets, weaker credit scores, all those kind of things. And we know where that led to in leading up to the mortgage crisis in 2006, 2007. So the banks are tightening. If you are not trying to do the best possible or take all possible steps to strengthen your credit score, to reduce the balances of your debt, you're doing yourself a huge disservice. I'm not saying everybody should be running out trying to get a loan, but if you need to get a loan for whatever it is, if you need to tap a bank for some resources, even to pull money out of your house, spoke about this before. I don't advise that. But if you do have equity in your home, you can't just go and pull the money out. You basically are borrowing the money from a bank. They're lending it to you for you to draw down equity in your home or anything else you have equity in, unless you're going to sell it outright. You have to have good credit to do that. You have to have a strong balance sheet, and you have to have reasonable amount or a very low amount of debt, especially to your income ratio. So these are things we have to be watching, people. I think it's a big deal. Talking about follow-up on the regional bank unfolding crisis, it's getting worse. We talked about New York Community Bank Corp last week, fell like 38%. It fell another 8 or 10%, I believe, on Friday. And now today, it was, I guess on Friday, late in the day, it was downgraded by Fitch. And today it says shares of New York Community Bank Corp dropped more than 6% on Monday, resuming their descent after a one-day reprieve following a downgrade by ratings agency Fitch and a price target cut by Citigroup. The bank's shares had plunged nearly 45% in 2 days after after reporting a surprise fourth quarter loss due to higher provisions tied to its commercial real estate portfolio. It says NYCB's results put spotlight on the banking industry's exposure to the troubled CRE sector, where borrowers are under pressure due to higher interest rates and lower occupancies due to remote work. Other mid-sized banks, this is important, have also felt the heat. On Monday, the KBW Regional Banking Index fell, it says, another 2.4%. While shares of Valley National Bank Corp and Bank United dropped 4.3% and 3.2% respectively. So this banking crisis is far from over. The banks are tightening standards. We have M2 money supply shrinking. We have credit shrinking. And this all has precipitated severe recessions in the past and further impact on the consumers. Lastly, I'll address, I saw earlier today, CNBC came out and said that now the average rate on the popular 30-year fixed mortgage has once again crossed back over 7% for the first time since December. And so these are things we have to be paying attention to. And don't forget, that's if you have excellent credit and you have a standard down payment. For those that don't have either or only one of those two things, you're paying much more than 7%. I saw something else that came out this afternoon from Powell saying that they're not in any hurry to lower rates just yet. So we'll continue to watch this. The stock market had some pressure today. I saw gold and silver were under a lot of pressure as well because the 10-year bond was just roaring. It spiked, I think, 13 basis points, well over 4.1% now. That's usually stock market negative. It's usually also negative for the metals. The dollar strengthened. So look at the charade continues. and let's see what happens with the markets tomorrow. I will close by saying I saw a very disturbing article I won't go into yet today. I want to see how it's going to pan out, where the Senate is looking at a piece of legislation to address the immigration problem. But unfortunately, it's tied to funding for a whole bunch of other worldwide conflicts. The terms of that proposed bill disturbed me greatly. I'd ask that you guys start doing a little research on that and see what you think. I'll address it separately in another show as time permits. With that being said, we're at 15 minutes. I hope you get your workout in today. Please get your steps. Start the week strong. Tighten up that diet. I'll be doing my workout here in about an hour, as I do 6 days a week. I did some treadmill this afternoon, took a half an hour break, put the files down, and walked a bit. So please do that. Keep the focus on getting yourself in shape. We all need to be in better shape, both physically and spiritually. So let's continue to build that. I hope you have a great rest of your day today. I'll see you all tomorrow. Okay, bye.